Is it too late to buy Bitcoin, Solana, and Kadena? Should we FOMO in now after Bitcoin has rallied 30% in the past 2 weeks, taking out this massive resistance box after Solana has taken out the FTX highs and Kadena has gone on a... okay, I don't know what's happened for Kadena. Kadena is the only altcoin which just seems like it's continuing to die. But nonetheless, should we FOMO into these altcoins and cryptos right now? Let's find out in today's video. So this has been a interesting week. Once again, we've seen another week of just a pure green rocket candle to the upside for cryptocurrencies, at least most cryptocurrencies. But nonetheless, I digress. In terms of what's happening in the rest of the markets, this is where things get very, very interesting. Divergences are continuing to grow and get stronger and stronger and stronger. And because of this, I want to talk about one brutal potential scenario which could be playing out for Bitcoin. Should we FOMO now? Should we look for better opportunities at better prices? Let's dive into it. So in terms of what's happened this week for the equity markets, we'll talk about all of the rest of the markets and then we'll talk about this scenario, which I think is going to take place for Bitcoin. And of course, you know, we're not going to be FOMOing in after 30% rallies. We're going to make a plan and we're going to stick to it. In terms of what's happened for the SP 500 this week, we've not only come down to our price targets between 4,200 and 1,120, but we've actually wicked beneath this massive, massive support box, and it is not looking good for the SP 500 in terms of where I think we're heading for the S&P in the immediate short term. I'd say we're coming down to the 618 Fibonacci, around about 3,917. Really, the psychological level at 4,000 is going to take precedence with a massive pit stop. We've also got wicks down here at the 0.5 Fibonacci at 4,050. But nonetheless, you know, what are my thoughts summarized in one sentence? S&P 500 for the next few weeks is probably going to continue moving back down. And I don't know about you, but I'm not entirely optimistic with the S&P 500 getting obliterated like this. And some of the charts we're going to show you reflecting the US economy sentiment in 1 second. The Bitcoin is just going to continue blasting to the upside, 69K in the next few weeks or so. Not 100% sure that's going to happen. So S&P down in terms of the iShares TIP ETF. Since the last time we updated this about 2 or 3 weeks ago, we're still coming down to bear market lows. We haven't really retested previous bear market lows in terms of the iShares. You know, it's anyone's guess at this moment in time. Could we come back up, retest the previous lows, come back down? Could we just keep on coming back down? Doesn't really matter. This is a macro chart anyway. In the macro picture, the kind of scape of this for me is that we are going to be moving back further to the downside. In terms of the IWM small cap US stocks reflecting how the US economy is doing as a whole, unlike the S&P 500, which we've detailed on this channel, has been very, very much propped up by a handful of stocks like Apple, Nvidia, Microsoft, which has been doing extremely well. And the rest of the US economy, of course, with the nature of the S&P 500, it cycles out all of these stocks which aren't performing well. So when we're coming over and looking at small cap stocks, they've just made new bear market lows. So the only thing I really want to comment in this regard is that in terms of where the US is at this moment in time, in terms of the global macro health, how is the economy doing? How is the world stage economy doing? It's not looking too good right now. And, you know, we've talked about this on the channel. I really don't want to talk about economic data in today's video. You know, we've gone through probably 100 economic data charts in the past month or so. Really, we don't need to, you know, dig deep into further economic charts. I don't know about you, but I'm somewhat sick of looking at these economic charts. Nothing's changed. These are all macro charts. You know my thoughts on what is happening in the macro right now. The IWM just further reflecting that on the weekly time frame as it is breaking down into new lows. I do not think this is going to end well. This is a massive, massive spread difference right now between the S&P 500 and the IWM. And typically these two asset classes don't have huge divergences unless something is monumentally broken in the macro. You can see, if we're looking at the weekly time frame now overlaying the S&P 500, let's put this in blue just to not confuse it with the orange Bitcoin color. As you can see, these normally track absolutely beautifully, not really having a monumental spread difference between them in terms of percentage differences. Of course, you can see these assets are dramatically priced at different levels, with the IWM down at 162 and the S&P 500 up at 4,117. But when we're overlaying these in terms of percentage growth changes, they don't differ all too much. They pretty much track each other to the teeth. And as you can see, something over here in March has monumentally changed, where the strength of the entire of the US economy has been making lower highs, you know, double topping lower highs, really showing that the whole US economy as a whole is not looking good right now. The global macro is not looking good right now. We've seen this in all of the economic data videos we've been presenting on the channel, the economy is not looking too healthy right now, but with the S&P 500 propped up by these, once again, small handful of upper echelon stocks like Apple, Nvidia, Microsoft, this is where we saw the massive divergence, with the S&P just absolutely blowing to the upside, blasting through all these resistances, which the greater economy, which small cap stocks were not able to do. And as small cap stocks are coming to the downside, you can see this divergence, this spread is still very, very great in the S&P 500 and the IWM, but it is still not come down to a close. We do just kind of imagine the S&P 500 could play catch up with the IWM. I'm definitely not saying this is going to happen in, a week, 2 weeks, a month. This could definitely take a very, very long time to narrow that spread. But if we do see these kind of come back on par with each other, that is an S&P 500 around the valuation of 3,700. If I zoom out, you can kind of see what I mean with what I said before, that these assets more or less beautifully track unless something monumentally has kind of really broken in the markets. In my opinion, the S&P has a lot of playing catch up to do at this moment in time. Tech stocks, the upper echelon of these stocks in the S&P 500, really the top 8, which has been holding up, which we've been talking about on the channel. These have been outperforming everything and dragging the S&P up while the rest of the economy is looking very, very shaky. So I think we've got some catch up to do. In terms of the VIX on the weekly time frame, as you can see, weekly VIX has been making higher lows, higher highs, blasting above this resistance box, which we were talking about on the channel. VIX is looking very, very healthy in the past week or so. 10-year government bonds making new all-time highs. The bond market still looking, bond yield still looking very, very strong right now. However, the 2-year government bonds have not made new all-time highs this week. In fact, they've had a pretty bearish week with a slight pullback to the downside. Now, really, in terms of 10-year, 2-year, 1-year, all of these bonds are still at very, very elevated levels. Like, I'm not exactly making a case that, this one candle right here in terms of the 2-year government bonds is the end of the world. I'm not even saying that we can't make new all-time highs. In fact, for the 2 years, I have been saying for the 2 years and the 10 years, I think we could continue to push up further, but it lines back into what I've been saying with peak risks and the bottom of yield curves on the channel. If we look at what's been happening in the 2-year government bonds, you can see since around about the 31st of October, yes, we're at all-time highs in the cycle, but we haven't been doing too much. We haven't been pushing up too much further since these tops over here. However, in terms of the 10-year government bonds, this is that same top in October time. We've clearly made a bull flag, we've blasted above it, we've retested it as support, and the 10-year government bonds are on a rally to the upside right now. This reflects that potentially peak fear in the markets has occurred. And you might be thinking, oh, peak fear has occurred. That's really, really bullish, right? Well, in terms of the bond market, no, it's not. What follows after peak fear is that recession starts slowly creeping into the corner. And when we're looking at the weekly time frame in the yield curve, looking at now the 10-year government bonds minus the 2-year government bonds, reflecting bond market sentiment, you can see the 10 minus 2 has started to come back to this reversion point. We came all the way down to negative 1.16%. This week, we almost came up to 0.011%. We're very, very close. Well, we're a little bit far away, but we're kind of close to coming back into that reversion to the mean for the yield curve. I won't go into too much detail for this. If you're a veteran, you know exactly what this means. If we come over to the monthly time frame, overlay a oscillator which displays the US recessions, you can see what happens is this. You have peak fear which comes into the markets, yield curve reverts. As it reverts back up to the upside, recession hits. Over here, you can see that peak fear starts to come, 2007, 2008 financial crisis, the reversion to the mean starts to happen back up to the upside. And after, not peak fear rather, I made a mistake there, not peak fear, peak risk. This is what peak risk looks like. When short-term government bonds have massively outperformed long-term government bonds, that is a risk play. It doesn't make sense. In terms of a traditional yield curve or treasury curve, it makes more sense that yields should be higher in the end of that spectrum. If you're taking out a government bond for 5 years, 10 years, you should be greater compensated than if you're taking out a bond for the next 1 to 2 years. The reason why short-term bonds are outperforming more is because of global uncertainty. Like we've been saying, this is peak risk. Short-term bonds taking over the yield of long-term bonds, that is peak risk. Then what happens is you have the reversion, and this, where the recession hits, that's where peak fear happens. So as you can see, every single time, peak risk, reversion to the mean, recession, peak fear. return to the normal. Over here, you can see inversion of the yield curve back in the 2019. That was peak risk. We then had a reversion back up to the upside, and you can imagine peak risk after the Black Swan event. Everything was just up, 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 up. And this is what we're seeing down here. You can see potentially the yield curve bottoming out in peak risk territory, and potentially we may be moving back up to the upside. And like you can see here with the oscillator displaying US recessions, these are my thoughts. This is what I've been saying on the channel. This is just one piece of economic data out of probably 100 charts that we talked about a month ago. You know, really, this is a higher time frame video. The economic data hasn't changed whatsoever in the past month or so. So if you've watched this video, are the markets repeating 2008? You know my thoughts. Like we've just talked about, we're seeing a lot of divergences right now. Bitcoin is just blasting to the upside. Altcoins are blasting to the upside, but the SP 500 is getting obliterated. Small cap stocks in the US are getting obliterated. The economic data looks terrible. iShares, TIP ETF, bond market, treasury returns are coming down to lows right now. And as we just talked about in terms of bonds are continuing to push up, at least 10-year bonds, 2-year bonds, not so much. That reflects potentially we've seen peak risk in the markets, followed by potentially peak fear in a recession. The VIX continuing to push up above this previous resistance, flip support. And on the weekly time frame, you can see, you know, this was support all throughout the 2021 rally in the VIX. This was, you know, over here, this looks like a swing failure pattern to me. We deviated beneath this. Now it looks like we're getting ready to rocket back up to the upside. So how does this all tie back into the next scenario for Bitcoin and altcoins? Should we FOMO now? Has something monumentally changed? Should we just accept the fact that Bitcoin has rallied 30% in the past 2 weeks and that's healthy and it's going to keep on pushing up and we should just FOMO now? In my opinion, no. Global liquidity, in my opinion, in the next week or so, this is going to come down to new bear market lows. Only 2 weeks ago, it made new bear market lows. Liquidity conditions are not supportive of any of these rallies that we're seeing in the cryptocurrency space at this moment in time. One of the charts which I detailed in my previous video was this one over here. Oh, it was actually 2 weeks ago, but this is just one thought that I shared which kind of has a counter argument to the 4-year cycle theory in Bitcoin. Now, in that video, I did specify, I think, you know, the explosive rallies that we see in Bitcoin every 4 year are not 100% to do with the halvings and the 4-year cycle. I think that does play some part into the cycle. I believe I said maybe 30 or 40%, but I said about 60 to 70% of the reason why I believe Bitcoin performs well in these explosive cycles is because of liquidity. Now, we've talked about this before on the channel. I'm not even going to, you know, overlay global net liquidity and show you all these examples. I just want to once again reaffirm my opinion and show you this chart with the M2 growth of the Fed, ECB, Bank of Japan, year-over-year supply. You can see every single time liquidity is injected into the markets, this is when you see Bitcoin go on these explosive rallies. Does the 4-year cycle take some part in it? Yes. Does it take precedence? In my opinion, no. Liquidity is far more important. You can see contractions in liquidity, bear markets, expansions in liquidity, bull markets, contractions in liquidity, bear markets, expansions in liquidity, bull markets, contractions in liquidity, bear markets. Now, in terms of the M2 year-over-year supply, not predominantly done by the US Fed, but at this moment in time, liquidity conditions are, in my opinion, not really supportive of a rally. Unless we see, you know, global liquidity just take an absolute turnaround at this moment in time and start blasting to the upside, then in my opinion, I don't really think Bitcoin can continue pushing further to the upside. Also, on Tuesday, we do have the next FOMC meeting. In my opinion, that could be roundabout where the next nail in the coffin is for the Bitcoin price. I personally don't think the Fed is going to be raising the rates this interest rate meeting, really because the inflation data hasn't changed too much. And in the previous meeting, they were happy to pause it. So in terms of what happens this meeting, I think they'll probably pause it, and that probably won't necessarily have an immediate impact on liquidity in Bitcoin. But in terms of the macro, holding these interest rates at very, very high levels is going to further contract global liquidity and put a tough pressure on what is happening in the market. So what do I think could potentially happen in the next week for Bitcoin? Well, here's what I'm looking at, because obviously this resistance box that we've drawn, you know, we can keep on pushing it up further and resisting. But this was the main level that I was looking at this moment in time, and I still think this is very, very important. This touch point over here at 32,000 and the top of the box that we originally drew at 32,300. So here is what I'm potentially looking at to take place in Bitcoin in the next week or so. I think it's very likely that we are going to start coming back down to around about 32,200, maybe just to wipe out all of the bulls at this moment in time in the market. Market makers, in my opinion, are probably going to drive us up to the CME gap at 36,000. That is what would make the most sense to me. If I was a market maker, if I was looking at this chart right now, I'm looking at this thin liquidity spread, especially, with these candles here. There's not much volume traded around here. You've just got pretty much a landslide up until these levels. I think it makes a lot of sense to at least come up and fill this CME gap around about 36,000, 36,180 approximately. Come up to this level, this would wipe out the late bulls. This would then wipe out the early bears, and then it would come down to the downside, wipe out the bulls once again as we potentially head down to this CME gap down here at 20,000. I've said this before on my channel. I've said it many, many times, and I'll say it once again. And it won't be the last time I say this. If you're a veteran, you would have heard this many, many times. I always say this: Bitcoin likes to follow the path of most pain. Now, was I expecting the path of most pain would involve Bitcoin moving up to 36,000 and then coming back down to the downside? Originally, no, but this is now how I'm looking at the markets. I think Bitcoin is probably going to trick the most amount of people, suck the most liquidity out of the most amount of people. That's probably what market makers are looking to do in this situation at this moment in time, and then potentially we could see a move back down to 20,000. That is currently my prediction on what is going to be taking place for Bitcoin over the next few months or so. So is it too late to buy crypto? Should we FOMO at this moment in time? I don't know about you. If you're a veteran of the channel, you would have remembered these videos that we made all the way back at the bear market lows talking about our DCA plan. Ignore the smiley face. Sometimes I draw that just to make sure that when I do close trading view that it has updated with all of the different things that I've done on it. So yeah, whatever. But nonetheless, when we look at the DCA plan, everything is exactly the same as we have been detailing on the channel. These are the regions where we previously DCA'd in the market. Remember, all the way back here, we were buying at 25, 24, 23, all the way down to our DCAs at 16,000. So in terms of, are we missing out on spot? Well, if you've been following the same plan as me, we're up on spot at this moment in time as well. We're doing very well on spot. I just personally don't think that we're going to continue moving up to the upside. So I want to look at the markets as rationally as possible. While we're up on spot, I of course want to make sure I'm maximizing my returns, making the most amount of money in these markets, and looking at this market with a complete level head. What I'm looking at this moment in time is, to me, is that there's probably about 70% probability of Bitcoin coming to the downside once that recession hits in Q1, Q2 of 2024, and that's when we could see round about 14,000 for Bitcoin before the next bull run. However, there is a small possibility that Bitcoin could just significantly diverge from the rest of the asset classes, but does a divergence mean we're going to do something like this? We're just going to keep on going up and up and up forever, and there's really going to be no opportunity to buy in on pullbacks in the market? Absolutely not. In my opinion, even in a bull or bear case, either way, I would be looking at this CME gap down here at 20,265. I'm potentially looking at adding to my DCA positions back down here at 20,300. Once again, these were levels that we DCA'd all the way back in at the 13th of June 2022. Of course, as you can see, all of these are our DCA targets which have been hit. These ones down here at 15 and 14 have not yet been hit at this moment in time. And of course, like I've been saying, we've already DCA'd. I'm not exactly waiting for new bear market lows, but I would like to accumulate as much as possible before that next cycle. So if we do come down to 20,000, I'm wrong about new lows, and we do just, bounce off the CME gap and come into the next bull run, that is absolutely fine for me. Like I've been saying, we've already DCA'd. We're happy to play both sides of the market. Because we've already DCA'd, it's very easy for me to just look at this with an absolute level head. And in either scenario, bull or bear case, we have just had an absolutely explosive rally for Bitcoin, which has disregarded pretty much every single market across the board, including liquidity. So is this going to continue blasting up into new all-time highs? In my opinion, no. I think even in a conservative case, 20,200 CME gap is going to get filled before we see any more upside. So there we go, my friends. I won't be FOMOing at these prices. We already DCA'd at much cheaper levels. I'm happy to sit on the sidelines. We're not in any trades at this moment in time, but if we do come up to 36,000, I will be entering a new position in the market. It will of course be a short position. We're going to start with low leverage at this moment in time. I'll talk a little bit more about how I'm planning to navigate that 36,000 position closer to the time. What I want to see is a little bit of a pullback first, potentially another rally back up to 36,000, and as we do potentially look like we're coming back up to 36, we'll make a new video. I want to make a new video specifically titled so people know that I'm going to be entering a trade. But yeah, those are my thoughts on the market. I'm not going to be FOMOing into Solana or Kadena. For me, these still look like they're in bearish territory. This is really just a macro reversion to these previous bear market lows for Solana for me. And for Kadena, I mean, we've seen this time after time again. Since $28, we've seen new bear market lows, bounce, retest, new bear market lows, bounce, retest. You get my gist. We're just following the same trickle effect, lower lows and lower highs. For Kadena, it's definitely looking interesting right now. We've had this pushback up to 54 cents, but this is such a weak rally compared to what's happening for the rest of the market. So for me, I'm pretty much 99% confident that we're going to see Kadena just start to roll back down to the downside and come down to new bear market lows. And one of the main reasons why I don't feel too much FOMO when I'm looking at these altcoins is when I look at the alt BTC pairs. One, we've already DCA'd into Bitcoin, so we're not exactly missing out on spot. Two, yes, some of these altcoins have started to outperform Bitcoin, but they're not outperforming by a dramatic landslide at this moment in time. A lot of these altcoins still look like they're making lower lows and lower highs against their Bitcoin pairs to me, especially something like Kadena. Kadena is still in a bear market against Bitcoin this week, despite the fact that we've had a pushback up to the upside. So for me, like I've been saying, I'm not ready to DCA into altcoins. I'm not ready to buy altcoins. Bitcoin's outperforming. I'm happy to sit on the sidelines and wait for that next trade from a position of strength. So for today, my friends, that's all I've got. Hope you enjoyed the video. I will update you closer to the time when I'm looking to enter a new trade on the markets. As always, if you did enjoy the video, make sure to let me know in the comment section down below by smashing that like button, leave a comment, share the videos with your friends. If you want to further support the channel, feel free to click the join button on YouTube and become a member today. It's been your boy Cowboy Trades. See you next year. I'm out. Peace.